Good afternoon, everyone. I know we have folks still logging in, but it's great to see that we have a significant contingency of folks who have joined us. So we want to respect your time and get started. I'm pleased that you saw fit to join us this afternoon. We have a pretty jam-packed agenda, so I will go ahead and jump right in. I am Karima Woods, the Commissioner of the Department of Insurance, Securities, and Banking, which you'll hear me refer to as the department. I also would like to just welcome you to today's hearing on gathering data related to unintentional bias in private passenger automobile insurance. I call the hearing to order at 3:00 p.m., actually 3:04 p.m. on this Wednesday, June 29th, 2022. I would like to just cover a few housekeeping items that will help the hearing run smoothly. First, just want to make sure everyone mutes your lines. I believe upon entry, it's automatically muted, but if you could keep them muted unless you're speaking, that would be great. Also, this will help to prevent any background noise from disrupting the meeting and ensure optimal sound quality. The hearing today is being recorded and will be placed on our department's website. Finally, the record for this hearing will remain open until July 8th to allow for the submission of additional formal written comments. And the department will continue to be receptive to input throughout the process. So I would like to just set the stage for the hearing by sharing a brief overview of our department, the purpose of the hearing, and next steps. The Department of Insurance, Securities, and Banking regulates insurance, securities, banking, and also financial services in the District of Columbia. Our mission is threefold. First, to cultivate a regulatory environment that protects consumers and attracts and retains financial services firms to the district. Second, to empower and educate residents on financial matters. And third, to provide financing to district small businesses. I'm joined here today by a few members of my team, but primarily with Philip Barlow, who is our Associate Commissioner for Insurance, and there are a number of other DISB team members throughout today's virtual call. Also, we have Kathy O'Neill, who's CEO, and Jake Appel, Chief Strategist from O'Neill Risk Consulting and Algorithmic Auditing, also known as ORCA. ORCA will assist the department in determining the data collected, and they will conduct the analysis and report the findings to the department. Kathy O'Neill will provide more information about ORCA's role in a few minutes. I want to be clear that the department will ultimately determine whether the data indicates unintentional bias and if any changes are necessary. A little background, the department chose to focus this review on private passenger automobile insurance to build on the previous work done by the department, including public hearings in 2018 and 2019, and a detailed review of selected insurers' use of models. The previous hearings were not directed to the same purpose, but the need to review underwriting and rating criteria and the potential for discriminatory impact was identified as an item for follow-up. The department did follow up with a detailed review of some insurers' use of models. And while the results of that review identified a few issues, the department determined that the models used by the insurers were working as intended. The prior reviews did not address the issue of whether specific factors used in the models result in disparate impact on certain district policyholders. The review being discussed today will take the next step. It will determine whether there is unintentional bias in the application of the underwriting and rating processes used by insurers. To give you an idea of the district's private passenger automobile insurance market, I can tell you that there are 27 insurance groups comprising 73 distinct insurance entities. that wrote private passenger auto insurance in the district in 2021. Combined, those insurers wrote $387 million worth of premiums. The top 5 groups write approximately 80% of the premiums, and the market shares have been fairly stable over the years. The purpose of this hearing is to kick off the department's deliberative and transparent process to identify evidence of unintentional bias in the underwriting and rating processes used by insurers writing private passenger automobile insurance in the District of Columbia. This is part of the department's diversity, equity, and inclusion work to explore whether the use of certain information by auto insurers in the application and underwriting process may cause harm to Black, Indigenous, people of color, and other protected classes of Washington, D.C. consumers. We're seeking input, both practical and conceptual, to help us determine how to structure the data call information we will request from the insurers and insights that will help us evaluate the data. As mentioned, this is the beginning of the process, and the department considers the information received today. We will schedule 1 or more follow-up meetings to discuss the details of the data call request. We want to ensure that we are getting the data we need and make the process of providing the data as straightforward as possible. We are fully committed to being transparent and will provide updates on the work. We will also be available to answer questions throughout the process. We will issue a report at the conclusion of the process. The report will not include company-specific information or findings. If substantive changes are needed to address unintentional bias, the department will develop an implementation plan to address the changes that will allow for a smooth transition. With that, now we will hear from Kathy O'Neill of ORCA. She will provide information about their process and the analysis they will perform. She will be followed by Associate Commissioner Philip Barlow. He will address how the department will collect the data and maintain confidentiality. After that, we will open up the hearing to those who have signed up to testify, and time permitting, we will take comments from attendees who do not sign up to speak. Public witnesses will be given 10 minutes to speak. After each speaker, we may have follow-up questions. Attendees, actually, after all of the speakers, we will have follow-up questions. Attendees who have questions should submit them using the chat function in WebEx. Before turning to the witnesses, I would like to remind everyone that the individuals who were not prepared to speak today or could not otherwise join us may submit written comments until July 8th, 2022. Comments may be submitted by email to Philip Barlow at philip.barlow@dc.gov. And Philip, if you could put that in the chat, that would be great. With that, I will turn things over to Kathy O'Neill for comments. Thank you.
Thank you so much, Commissioner. I'm just going to share my presentation. I hope you can all see that.
Yes, we can see it.
Okay, great. So I thank you very much for the introduction. I'm Kathy O'Neill. I wrote a book about the dark side of big data and what could go wrong in predictive algorithms called Weapons of Math Destruction in 2016. I also started ORCA in 2016. And I just wanted to give you guys a flavor of unintentional bias and how it can come about. There's actually quite a few different ways. One of them is that the training data is biased itself, and the sort of primary example of that comes from the world of facial recognition. This is the gender shade study that was done by Joy Buolamwini and Timnit Gebru and Deb Raji, where they looked at the accuracy results for along race and gender lines and found that the sort of headline accuracy that the companies were touting were generally true, but only for white men. And for darker skin tones or for women, and particularly for Black women, the accuracy rates were as low as 65%. So this can happen by accident, essentially, or by default is a better way of saying that. The training data that these facial recognition software were trained on were mostly white men, and that's why they optimized to that kind of performance. Since this study came out, this little audit, IBM and Microsoft, they've improved their algorithm by improving their training data. So that's one reason that you'll see a bias in this kind of thing. Here's another example I wanted to bring up from the world of hiring. Amazon built an algorithm to try to predict who would be a good person to hire in engineering based on the data they had from people that they had hired in the past in engineering. I haven't actually spoken to someone who worked on that algorithm, but if they followed standard procedure, they developed a notion of success, like every predictive algorithm has, and they said, who in the past looked successful? That success probably depended crucially on things like who gets promoted, who gets raises, who gets hired in the first place, who gets good end of year reviews. The problem with relying on that kind of definition is that they're all subjective, and they've all independently been audited for bias and found to have bias typically. So when Amazon built this algorithm to decide who they should look for in a current hiring pool, a current application pool, they found that, unsurprisingly, there was a gender bias to their algorithm. That doesn't necessarily mean that the women in the past performed less well as engineers, but it means that the statistics they chose to measure performance had bias. And they decided not to use that. They decided not to use that algorithm, and good for them for not using it. But I just wanted to point out that it was unintentional bias that they found embedded in the algorithm because it was itself embedded in the data. Nobody wanted there to be a gender bias, and in fact, they decided just to discard the data, the model altogether because they found it. So this can happen. Then the final example I'll give you before launching into the approach that Orca wants to take is from the world of credit. This was a headline news in the New York Times that the Apple Card was accused on Twitter in a viral accusation of having gender bias by a prominent user of Twitter who had applied himself and his wife to the Apple Card, and he had gotten something like 10 times more of a credit line than his wife, even though they shared finances. One of the things I want to point out here is that you really can't make an accusation of sexism with 2 data points. This sexism is actually a statistical question, as is racism or anything like that. These are very statistical questions. And the good news is they were investigated and they were found to be cleared. I mean, Apple Card was cleared. And the business that owned the Apple Card, which is Goldman Sachs, were cleared of these charges by the Department of Financial Services of New York. I still think, though, that what's interesting is that they hadn't prepared a defense. They hadn't anticipated that this could be an accusation on Twitter. They hadn't prepared a defense, and I think what we're seeing all over in all these different realms and all these different industries is that we really need to start thinking about this in advance before a viral Twitter event. So now to DISB's, the department's approach. So the auto insurance carriers in the DC area are going to be asked for some data. And the idea is we want to, Orca has been charged with measuring the differences for people of different races, the differences in outcomes, whether that's who gets offers of insurance, of car insurance, or what the price is for that insurance. Now, it's understandable that this seems strange because I know that race information is not collected by car insurance companies. So we're going to infer race, and I'm going to explain our methodology for inferring the race. And then I'm going to give you just a very, very basic graph to indicate the kind of very basic analysis that we plan to do. So the tricky part of the data work is, well, first of all, keeping it secure, um, and 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 doing this race methodology, race inference methodology. The actual analysis, once we have inferred race, is quite straightforward in this first phase, because all we're doing is we're looking for differences in outcomes in the most basic question, in the most basic sense. So we're using a methodology called BIFSG, and I won't tell you what that stands for, but it is a Bayesian methodology, which basically uses the U.S. Census, and we're referring to the 2010 census here, which is available for researchers like us, like ourselves. And it basically, you can think about it as multi-step process. It says, where do you live? What census block do you live in? Well, okay, that census block, is, 75% Hispanic. So the chances are that you're Hispanic. Actually, we wouldn't say, we would stop there. We would say, well, by the way, what's your last name? Oh, people with that last name are 95% of the time they're Hispanic on the census. So we're going to up our probability that you're Hispanic because we have two pieces of information. First, your address, and next, your last name. And then the third step is, oh, by the way, what's your first name? Oh, people with that first name are also likely to be Hispanic. And then after those three pieces of information, we would probably infer that most likely the person that we're talking about is Hispanic. So it's a three-step process that uses sort of Bayesian learning techniques. I will point out that because of the segregated nature of Washington, D.C., this methodology is probably going to work better than it does in average because it's an extra segregated area of the country. This is not a perfect methodology, but it works quite well, and it works better when that first step I mentioned, like where do you live, what census block are you in, has a stronger suspicion of a particular race and ethnicity. The methodology BIFSG was originally developed by the RAND Corporation. We've used it in our work with attorneys general. The Consumer Financial Protection Bureau also used it in some subprime auto cases. And as I mentioned, they developed the BIFSG, right? They developed the BISG, the one that without the first name, with just the address and the last name, and then we added the first name because it improves the results somewhat. I will point out some caveats about this methodology. In full disclosure, the 2020 census is going to be different. People have moved. Also, the questions about race and ethnicity, self-identifying, the questions themselves have changed. The categories have changed. There's a lot more people, as we understand it, who identify as multiracial. So this methodology, when we update it with new data, will look a little bit different. The most common mistake of this methodology is that African Americans are classified as white. So the chances are that if there is a mistake, the mistake is misclassifying an African American as a white person. So we will guess wrong for those people. But I want to point out that if there is a difference in outcomes between African Americans and whites, which is certainly something we will be paying a lot of attention to, this type of error where we put African Americans into the white category accidentally tends to underestimate the gap. So there's a, what I guess the point is that there is a question mark around the methodology, but the question mark will tend to underestimate the disparity, the differences in outcomes. And I'll just point out that, like, one of the great things about using this on a large scale is that even though there will be individuals who are misclassified, the statistical strength of the BIFSG methodology is quite strong. So even though there will be some sort of mistakes at the individual level, they mostly even out actually. And so besides what I just mentioned about the disparities getting a little bit watered down when we have that particular type of mistake, we can trust the actual measured differences if we have enough data, which we hopefully will after the data call. And I also would finally mention that we wouldn't want to use, we probably would refrain from using BIFSG to actually identify a specific individual as a specific race. It's not meant for that. It's actually meant to use for these kinds of aggregate statistics. And that's how we'll be using it. I think this is my final slide. I just want to point out that the analysis we're going to do once we have the inferred race data, whether it's this is a snapshot, this is a mock-up of sort of a binary outcome. How many people actually got offered car insurance after they applied? And we will sort of infer the race of everybody who we have data for, and then we will say what's the sort of frequency or the rate of acceptance with that binary outcome per racial category. And I don't even know if this is exactly the racial categories we'll end up choosing, but it could be these 4 categories, or we might look at it in many different ways. We'd also want to have error terms. So that's what those little bars show you that they might that there is some uncertainty even in the data, which the error bars will get smaller as we have more data. So that's the sketch of our approach, and I'm going to figure out how to stop my share now. Thank you.
Thanks, Kathy. We did get a question in the chat that if you can address maybe, what's the accuracy for BIFSG? Is that something that may be a complicated thing to answer? But
so the BIFSG is actually two answers. So the first thing is that there was a footnote in that slide presentation. I hope we can share that. That has an explanation of the kinds of statistical errors that BIFSG makes on average. But I think the question is probably the person asking the question probably meant to ask, how much of a signal of how much of a difference in outcomes would there have to be for us to be able to substantiate that using the BIFSG methodology. And the answer is the larger the signal, the larger the difference in outcomes, the less data we will need to substantiate it, because we'll be able to infer the race of let's say 5,000 people. That would be enough if there's enough of a difference. That would be enough to have a certain sort of a statistically significant amount of evidence that there really is a difference. If it's a very small difference in outcomes, if it's white applicants get 89% and black applicants get 88%, it's a very small difference. We would need a lot more data to sort of give convincing evidence of that difference. I hope that answers the question.
Thanks, Kathy. So the next up is me, and I'm going to talk a little bit about how we're going to go about getting the data and protecting the confidentiality. As Commissioner Woods mentioned, our review of the 2021 financial statements identified 27 insurance groups with premiums reported for private passenger auto insurance. Since we will be asking for personally identifiable information to do the inference that was just discussed by Kathy, we will request this data under a market conduct examination. So we anticipate issuing each of the insurance groups an examination warrant. Some of those groups only reported a small amount of or negative premiums, but we are interested in any insurer currently accepting applications for private passenger auto insurance in the district. We will also review 2020 quarterly statement data to see if any additional groups need to be included. Although we are going to do this under a market conduct examination, the department is not expecting to engage any additional outside contractors, so we do not expect there to be any cost to the insurers examined other than the time and effort to respond to the data call and any questions we may have. The department and ORCA would like to get assistance from some or all of the insurance groups as we develop the data call. We believe that participation by the insurers as we develop the data call will make it easier for the insurers to respond. I recall from my days working for an insurance company that some data which seems like it might be very easy to collect turns out to be very difficult, but other data that can get the regulator to the same place is easy. So to take a simple example, if we wanted to know the age of an applicant, we could get that by asking for the age, or we could ask for the date of birth. And one might be easier to provide than the other. We could also set up the data call templates to provide alternate ways of providing some data, and insurers could pick the one that works best for them, since we will do one data call to all of the companies. Beyond the technical aspects of the data call, we believe the insurers also have information that can help us develop a data call that will best address the question at hand, and we would like to avail ourselves of your expertise. These efforts to make the data call easier and most useful will require interactions with the insurers as we develop the data call. Finally, although we expect to be mostly working directly with the insurers to address these questions, we will make the data call template public before issuing it to get feedback from other stakeholders. And now I will turn it back over to the commissioner to start with the public witnesses.
Great, thank you, Philip, and thank you, Kathy. We have a number of witnesses that have signed up to speak, so I will go ahead and move forward with our first public witness. I will say that we will hold all questions for public witnesses until we have completed hearing from all of them. So our first public witness is Michael DeLong with Consumer Federation of America. If you have any presentations, I recommend that you directly upload them as you're preparing to speak. Thank you.
Okay, thank you very much. This is Michael DeLong from Consumer Federation of America. I'm just going to talk. I'm here on behalf of CFA. We're an association of nonprofit consumer groups. We were founded in 1968 to advance the consumer interest through research, advocacy, and education. We have over 250 members, and our testimony on bias in auto insurance underwriting and rating criteria, it's based on our many years of insurance research and advocacy, and we wanted to thank you and the department for doing this. The District of Columbia requires drivers to purchase auto insurance. And as a result, the department, you have a special responsibility to make sure that auto insurance is affordable and that consumers aren't subject to unfair bias, intentional or unintentional. But in the course of our work, we found substantial bias in auto insurance rating and underwriting. Auto insurers currently use numerous non-driving related factors that are socioeconomic in nature, and they result in unfair discrimination, leaving certain consumers with clean driving records to pay significantly higher premiums. And these rating factors include someone's education level, their job title, their gender, whether they're married, their home ownership status, the zip code or neighborhood they live in, and last but not least, their credit history. And the use of these non-driving characteristics for pricing has a disproportionate impact on people of color and low-income people in the district. Recently, Consumer Federation of America acquired data from Quadrant Information Services, a data broker, and it reveals the impact of credit history on auto insurance premiums charged by the largest insurers in every zip code in the United States. We analyzed this data specifically for Washington, D.C., and we found that auto insurers charge residents with lower credit-based insurance scores dramatically higher premiums based on their credit history, even if they have perfect driving records. For example, drivers in the District of Columbia who have excellent credit and no tickets, accidents, or claims, they pay an average annual premium of $704. But if those same drivers have fair credit, their average premium climbs to $1,003. And if they have poor credit, their premium climbs further to $1,499. That's a 113% increase, and that happens even if all their other factors remain exactly the same. We found that most of the largest insurers do this. In fact, all the 7 largest auto insurers impose a credit penalty. The smallest credit penalty is imposed by Allstate, but they still force consumers with perfect driving records and poor credit to pay 42% higher premiums than drivers with perfect driving records and excellent credit. And other companies have imposed larger penalties. One of the biggest is imposed by Erie Insurance. They require consumers with poor credit to pay 211% higher premiums compared to those with excellent credit. Also noteworthy is that Progressive is Progressive because their policies are quite expensive. Their consumers with poor credit pay an average annual premium of $2,738, which is a considerable burden, especially for people who are working in low-income jobs. And all this data is based on the district's minimum required liability coverage, and the driver profile is exactly the same. It's a 35-year-old unmarried driver with a license for 19 years, perfect driving record. They have a high school diploma, rent their home, and they drive a 2011 Honda Civic on a 12-mile commute 5 days per week for a total of 12,000 miles or so per year. And our data has also found that there's other forms of discrimination. On average, women in the District of Columbia pay more for auto insurance than men. The average premium charged to men is $979. The average premium charged to women is $996. And since the use of gender is quite inconsistent, there are some insurers that charge men higher premiums, but more who charge women higher premiums. We have grave doubts about this being a reliable rating factor. And it's not just our study. Other reports have shown that consumers pay more for auto insurance if they have, say, lower levels of education or if they work in lower paying jobs. Last year, in January 2021, Consumer Reports did their own study. They collected auto insurance quotes from 9 insurers in a bunch of different zip codes, including 6 states and the District of Columbia. And they found that 3 insurance companies, Geico, Liberty Mutual, and Progressive, charged consumers higher premiums if they only had a high school degree. Liberty Mutual charged them $62 more on average, or 6.3% higher. Progressive charged them $101 more, or 12.9%. And Geico charged high school graduates $115 more, or 16.4% on average. The study also found that Geico and Progressive charged higher premiums to drivers who worked in lower paying jobs. The jobs compared were that of a cashier and that of an executive. Progressive charged cashiers about 3.8% more, and Geico charged them about 13.5% more. And insurers' use of these socioeconomic factors, it especially harms Black, Latino, and Indigenous consumers. Because there's still widespread discrimination, both past and present, Black, Latino, and Indigenous consumers tend to have worse credit. And other socioeconomic factors have a similar impact. For example, Black drivers, they're less likely to own their own homes. They're less likely to be married or to have a college degree or to work in high-paying jobs. And they're more likely to be renters, to be single, to have only graduated from high school, or to work in lower-paying jobs or have a low credit score. And when the use of these non-driving factors is employed in auto insurance pricing and underwriting, it results in consumers paying more and the perpetuation of already existing racism and racial inequalities. And like these models, the use of big data to fuel more complex algorithms, it can result in the perpetuation and amplification of unintentional bias and discrimination. If, as we heard, an algorithm is built from inaccurate or biased information or starting points, it's going to produce and reinforce systemic racism and other prejudices that preceded the model. But it's not just the unintended outputs of these models that we should be concerned about. It's also problematic outcomes that are intended. And in 2015, there was a report from Consumer Reports. They found that Washington, D.C. drivers' premium more than doubled if they had a clean driving record but had poor credit rather than excellent credit. So that's additional evidence for the impact of credit. Average premiums went from about $1,420 to $2,957. But they also found that a driver with excellent credit and a drunk driving conviction paid less. Their average premium only rose to $2,215. So insurers were charging 25% less to drunk drivers with excellent credit than to safe drivers with poor credit because their model intentionally valued credit more than safe driving history. And we recommend a couple of possible solutions for this overarching problem. First, the department could recognize that these socioeconomic pricing factors result in unfair discrimination and prohibit their use. California, Hawaii, and Massachusetts have already banned the use of credit scores. 6 states ban the use of gender. Some other states have placed limits on the use of education or occupation or other factors. Just a few years ago, New York did a process where they looked at the use of education and occupation in auto insurance, as found that it was leading to unfair discrimination, and told insurers to fix this or stop using these factors, and the insurers stopped using them. But alternatively, if you prefer not to prescribe specific factors, you could require insurers to demonstrate that these algorithms, data models, and various factors do not result in unfair discrimination. And if they do result in unfair discrimination, to fix that. This approach has been adopted in Colorado. Last year, they passed a bill, SB 21169, and they're currently holding a stakeholder process to get input on these rating factors. This is just a beginning. We're happy to send along more information. Thank you very much, and please contact us if you have any questions.
Thank you, Michael. And I'm sure there'll be some questions after we get through all of our witnesses. The next public witness that is signed up to speak is Bernie Vernbaum with Center for Economic Justice. Is Bernie on the line?
Yes, thank you, Commissioner. Can you hear me okay?
Yes, I can. Thank you.
Great. So I'm Bernie Vernbaum. I'm the director of the Center for Economic Justice, a consumer organization that advocates on behalf of consumers on insurance and other financial services. I've worked on racial equity in insurance since 1991 as a regulator, consultant to public agencies, and consumer representative. I currently chair the Availability Subcommittee of the Federal Advisory Committee on Insurance, and I've also served as a designated NAIC consumer representative, having made many presentations on these issues before a wide variety of insurance and public policy stakeholders. By training and experience, I have expertise in both economic and actuarial issues in insurance. So thank you for your efforts in this area. Just have a few comments at this point. The first is it's necessary to examine insurers' algorithms in a holistic manner. And by this, I mean not just examining individual data sources and types used by the insurer, but examining the algorithms and the resulting output of those algorithms. Examining only individual variables misses the interaction among the predictive variables. Second, it's necessary to use data on prohibited characteristics to examine bias on the basis of those characteristics, as Ms. O'Neill has outlined for us today. This should be obvious. You can't measure racial bias or the lack of racial bias without actually including a variable for race. Third, DISB and insurers should be examining algorithms and data sources used by insurers at every phase of the insurance life cycle as part of a holistic approach, including marketing, claims settlement, and anti-fraud, in addition to underwriting and rating. Of the various phases of the insurance life cycle, underwriting and rating already get the most attention. There's been no scrutiny of marketing, claims settlement, and anti-fraud for racial bias, yet the types of data used in algorithms for those phases of the insurance life cycle raise even greater concern than the already great concern for data sources and types used for underwriting and rating. Examining marketing data sources, types, and algorithms is particularly important because the use of big data has enabled insurers to micro-target consumers in real time. So in combination with real-time AI used in digital interaction with consumers, marketing algorithms are effectively the gatekeeper for consumer access to insurance, such that marketing algorithms effectively perform as underwriting before the consumer even gets to the premium quote phase. Fourth, robust and granular data collection reporting by insurers on consumer market outcomes clearly must be a part of any effort to address systemic racism in insurance, and it's contemplated in your examination. You can't perform the analyses needed to examine, identify, and minimize systemic racism in insurance without the relevant data. In addition, algorithms don't always perform as intended, so just because an algorithm doesn't indicate racial bias is no guarantee the effects of the algorithm will be bias-free. And while you will likely, certainly need to utilize a special data call for the current effort, for the medium and long term, we urge you to utilize a re-engineered statistical data collection system with a revised transaction detail statistical plan and revised statistical agent requirements. The reason you have to do a special data call for this examination is because the current statistical data collection system is outdated and of little use to regulators. If you look to other financial services regulators, they collect the data they need to do these types of analyses in real time. Fifth, testing for racial bias is not rocket science. Financial service providers have been doing such testing for over 4 decades. And while the application to insurance has been limited over that time, this examination should take months, not years. Sixth, testing for racial bias is consistent with risk-based pricing framework of insurance. Such testing identifies data sources and types that simply predict race and not the insurance outcome. That's proxy discrimination, as well as data sources and types that, while being predictive of risk to some degree, also have a disproportionately negative impact on protected classes because of historical discrimination. That's disparate impact. Eliminating proxy discrimination is simply eliminating a spurious correlation. It clearly improves risk-based practices. And identifying disparate impact creates an opportunity for both public discourse about fairness and equity. Measuring something isn't meaningful unless you have clearly defined what outcomes you are measuring. So we urge you to use proxy discrimination and disparate impact as metrics for measuring racial bias. Last, I want to close with the title of a paper written and published in 1986 by Leah Wortham, called Insurance Classification, Too Important to be Left to Actuaries. While existing insurance laws regarding unfair discrimination require that data sources or types must have a statistically and actuarially valid relationship to the insurance outcome, the fact that a data source or type has such a relationship does not mean it must be used. If a correlation between a data source or type and an insurance outcome was all that was needed, there would be no limitations on insurers and no prohibitions on the use of race, religion, or other protected class characteristics. Further, some correlations may reflect historic racial discrimination. So we ask you to stay true to the risk-based framework of insurance, but recognize that limiting the use of certain types of information may dramatically improve fairness and equity with little or no impact on the risk-based foundation of insurance. And moving towards greater equity and fairness, overcoming structural racism in insurance is as important as any task before you as regulators. Insurance is essential for individual and community economic development. Too large a share of our society have resources so limited they cannot withstand even a small financial or economic disaster. Insurance is the financial security tool that enables low and moderate income consumers to withstand and recover from a car accident, a natural disaster, or death of a breadwinner. Addressing structural racism in insurance lifts all boats by creating a more resilient and sustainable community. Thank you.
Thank you for your testimony today, Bernie. Moving on to our next public witness, we have Daniel Schwartz, who has signed up to speak. Is Daniel on the line?
I am here. Thank you very much.
Okay, excellent.
Well, I want to thank you for holding this important hearing. And while I was planning on giving a PowerPoint presentation, I actually think I'm going to forego it. But what I am going to do is, this is, of course, a very big topic, and it's one I've written on pretty extensively. I guess I should introduce myself. I'm a professor at the University of Minnesota Law School, and I've been working on these issues for many years alongside many of the other folks who are testifying. But what I would encourage folks to do to get a much more fulsome sense of my view is to read my work on this. And so I just posted in the chat my link to a paper that I wrote on this that sort of contains a much more detailed description of what I'm about to say. But I want to first start out by recognizing that I think absolutely the place that ORCA is in and the DC Department is exactly the right first step. And that is to determine whether or not there is a disparate impact that is produced by current rating and underwriting algorithms. And there is no way of doing that without trying to understand what the identities are of policyholders. And so the approach that ORCA is using seems to me to very much be the right approach, given that we do not have current data on things like race and ethnicity of policyholders. But what I would suggest is that there's actually no reason why insurers ought not to collect that data. And in fact, in many contexts, we require, for instance, mortgage providers to collect that data precisely so we can audit their algorithms and determine whether or not there is a problem. So given the situation we're in, I think the approach that is being used is the correct one. But what I would suggest is that in the future, there should be greater scrutiny to the very fact that we do not collect the data necessary to conduct these inquiries without making statistical inferences. Now, the broader issue I want to discuss is what happens after we analyze whether or not there is a disparate impact. And the answer to that is not obvious, I think. So far, we've heard suggestions that to the extent certain minority groups or certain protected groups are charged more for insurance, that prima facie creates a problem. And I'm not so sure that's right. But I'm also quite sure that speakers after me are going to suggest, look, the mere fact that there are discrepancies in the rates that are charged to folks on the basis of race doesn't mean that there's a problem at all, because that might be expected using a risk-based model. So I think the really hard question that needs to be asked, and that I haven't really heard enough discussion of yet, is what do we do if, and frankly, when we find that there are discrepancies? Because I think I would be very surprised, frankly, if the result of this analysis does not show that indeed African Americans are charged more for insurance. African Americans more frequently get denied coverage. We've seen that in other studies, and I think that it's likely that's what this analysis will do. I think there are a few answers to that. The first clear answer is companies have to be able to show that any differences in rates correspond to differences in claims rates. And so what needs to be collected in addition to prices and in addition to policyholder characteristics are ultimate claims payments. Now, traditionally, insurers have been very reluctant to give that information, but in my mind, it's very difficult to make any conclusions at all about unfair discrimination if you're just collecting data about prices, but you're not collecting data about payouts. After all, the value of insurance is determined not only by how much you pay, but how much you ultimately can expect to get out. And so the very first test that I would suggest must be met in order for it to be clear, or in order to sort of assure yourself that there's not a really big problem, is that to the extent there are discrepancies in prices, that those discrepancies also carry through with respect to claims payments. And so one way of thinking about this is, do loss ratios differ across different protected groups or not? And I think that's the very first question that needs to be asked. And I think it needs to be asked not only within a single insurer. So it would obviously be very problematic if within a single insurer, loss ratios for African Americans were more favorable for the insurer than loss ratios for whites. But it also needs to be asked for the market as a whole, right? If some insurers focus on serving African Americans and they actually have much worse loss ratios, or much more favorable loss ratios for them, much less favorable loss ratios for policyholders, and other insurers focus on serving the majority population, that suggests that there's a market problem, even if no individual insurer is producing that result. So I think you need to ask the question about loss ratios, both with respect to individual companies across protected groups and with respect to the aggregate market across individual groups. Now, the second thing I would suggest is the mere fact that loss ratios are equal across different groups should not lead you to the conclusion that there is no problem. Because the next question that needs to be asked is, well, why is it that if a certain minority group is being charged more but has higher claims, why is it that they have higher claims? And is the reason that they have higher claims something that insurers can permissibly take into account? We normally allow insurers to price based on risk, but we have in DC and throughout this country some limitations on risk-based pricing. So for instance, let's take an example where we have data that suggests that African Americans in general face larger liability when they're in an auto accident. But the reason for that is not that the auto accidents are any worse or people are damaged anymore. It's just because African Americans are more likely to be sued because there's bias, right? So if a white person gets into an auto accident with a black person, they're 2 or 3 times more likely to sue. Now, obviously, I'm just making this up to illustrate the point. But if that were true, then costs would be higher for African Americans than for whites, but we nonetheless, under the law, would not allow insurers to take that into account. Why? Because the way the laws are structured is that we not only say in general that you need to have risk-based pricing, but we say even within a risk-based pricing structure, there are certain characteristics you cannot take into account because there are larger factors at play. And so, for instance, an insurer couldn't come into your office and say, well, look, I charge more to African Americans. I explicitly use race, but I can show you there's a statistical correlation. You'd say, no, the reason why we prohibit the use of race is much larger than the reason why we require actuarially fair algorithms. And so even if the loss ratios are the same, the next question has to be, to the extent the loss ratios are the same but claims are higher, why are they higher? And are they higher for reasons that can be disentangled from race? Maybe it's, African Americans are more car accidents. Maybe there are other factors that have nothing to do with race that can be disaggregated. Or are the reasons that they are charged more inextricably linked to the protected characteristic? In which case, insurers are not permitted to take into account that characteristic, even if the characteristic is predictive. Now, that is, I think, only an analysis you can do once you have the first order question of how much of a disparate impact is there and how much of a loss ratio is there, because that requires some detailed analysis of the algorithms. The third point that I'll make in my last minute is, even if it can be shown, one, that differences in premiums are justified by differences in loss ratios. Two, that differences in premiums and loss ratios are attributable to neutral factors that can be completely disentangled from impermissible factors. It still is appropriate for the department to ask, to what extent are there equally predictive characteristics that you can take into account that may produce less of a disparate impact. And that's a very familiar concept in the law, where even if there's a disparate impact, we ask for a legitimate explanation of that. And if there's a legitimate explanation, we say, okay, but could you do more to prevent that bias while at the same time achieving your outcomes? Now, that is, I think, the most controversial element, but I would say that all three of those inquiries are where you should go next once you find what I predict you will find, that there are large discrepancies. Thank you very much.
Thank you, Daniel, for your testimony. And for the record, I didn't state it earlier, but Daniel, you're affiliated with University of Minnesota Law School, correct?
That is correct, but just to be clear, I'm not speaking on behalf of the University of Minnesota Law School. I'm
Okay.
only speaking on my own behalf.
On your own behalf. Okay, great. Thank you for that clarification. The next witness that we have, two witnesses from the American Property Casualty Insurance Association, Nancy Egan and David Schneider. Are you both on the call? I know I saw Nancy earlier.
I am, Commissioner. Can you hear me all right?
Yes, I can. Thank you.
And
Well,
Dave's going to lead us off, so I jump in after him. Thank you so much.
Well, the first thing I want to say is express our appreciation for the care with which DISB is going about this process. We share with you, with DISB, with consumers and the public generally concern with racial bias issues, and we believe they should be addressed, and look forward to working with you, the department, and all the stakeholders and finding the best way to do that, consistent with the department's other responsibility, which is to maintain a competitive and innovative insurance market. APCIA represents about 57.2% of the private passenger auto insurance market, and we're proud of the fact that our companies have served consumers in the District of Columbia each and every day and have done so for decades. We at APCIA also have a major initiative on diversity, equity, and inclusion, and would very much like to meet with you, Commissioner, and with your staff to discuss the other elements of our work in that area to see what more we can do to further the goal of improving diversity, equity, and inclusion. So that's an offer we'd like to make and would very much love to meet with you on that. The District of Columbia is also personally important to me because we have a major office at 12th and F Street, and I worship in the District of Columbia. So as you can tell, I spend a lot of time in the District of Columbia. So what you do is important to me as a consumer and as a matter of the public. So once again, thank you for holding this hearing today, for including the industry, for working with us, and we appreciate especially the next steps involving the best ways we can work with you to answer the questions that are legitimately asked. So today, because we're relatively early in the process, most of our testimony relates to questions and sometimes concerns, and we look forward to working with you and all other stakeholders and addressing those questions and concerns. To begin with, DISB's stated motivation for the data call is to determine if there are practices causing harm to protected classes, but there's no definition of harm in the proposal. What does the department contemplate as what constitutes harm to an insured? And how does that relate to risk that may be presented by a particular insured or insureds in general? I note from the first presentation you heard from Consumer Federation of America, they talked about rating factors which are subject to your regulation, and for proof that in fact all the rating factors that they mentioned actually relate to and help assess risk. So I think one of the fundamental questions we have is how is the issue of comparative risk going to figure into this discussion? In addition, DISB's motivation section specifically lists targets rating factors that, as I mentioned, are filed with the department and are constantly tested in the market for their accuracy and tested by DISB for compliance with the legal standards that you have the responsibility to enforce and we have an obligation, an absolute obligation to comply with those legal standards. Now, we'll raise some additional questions, and again, we look forward to working with you as you pursue this initiative to find out how best to answer the fundamental questions consistent with, again, with the law that has been established, that you enforce and we comply with. Given the amount of data already collected by the department and at its disposal, the proposed collection of application data seems costly, complicated, and unnecessary. The information provided in connection with the hearing states that the necessary data is unavailable according to subject matter consultants contacted by the internal staff. Could DISB let us know who those consultants are? The study states that application data is to be collected as opposed to the already available information in rate filings and market conduct examinations, including the special market conduct examinations of the 4 largest carriers already carried out. Has any report been released, and what were the findings from your prior work? The specific details of what information is to be collected remain unclear at this point, and we look forward to working with you to find out what those are and what can be done in a cost-effective manner. Operating systems of the various carriers differ, and application data would have to be collected from a wide variety of sources with many different systems, including independent agents, captive agents, companies, and websites. At what stage in the underwriting process would the data represent? Quotes, final premiums, and what if the consumer rejects the quote? Is all new applications issued during a certain period covered? Will this test need to be completed prior to submission of data? Will this require a reprogramming of company operating systems? We're also, as we're mentioned, concerned with the exchange of a great deal of personal information. Will that require special and additional new protections to be put in place by DISB and its contractor in order to process the kinds of information that we're talking about? Why this expensive approach when DISB already has access to all the information it needs to determine if insurers' underwriting and rating practices comply with the law, as exemplified by Section 31-2703? We note as well that this is a particularly difficult time for consumers and for the insurance industry in terms of inflation and rising costs. And so we hope that we can pursue whatever the needs are for the department in a cost-effective manner, particularly needed in this time of stress for both consumers and insurance companies in terms of the inflationary impact on the goods and services that are covered by automobile insurance. The apparent standard for review of the data, quote, potential for unintentional bias, is ambiguous to us and exists, as far as we know, nowhere in the current law with which insurers must comply and regulators must enforce. To the contrary, the fundamental statutory standard with which insurers must comply and against which regulators must enforce is embodied in the excessive, inadequate, unfairly discriminatory standard in Section 31-2703, for example. The definition of each element of the rating standard set forth in Section 31-2703 requires an examination of the risk of loss. In fact, the universally accepted purpose of the unfairly discriminatory element of the rating standard is to prohibit rates that treat people with similar risk profiles differently. The proposed study's use of the potential for unintentional bias language to describe the standard against which the data will be collected and studied seems inconsistent, if not in conflict, with the legislated and established standards, which in turn gives rise to many fundamental questions that we have about the study. So in our view, there are really 2 fundamental questions. The first is, what is the data that would be requested, and is it more cost-effective or better than data that the department has and can receive through previously established and well-known channels? And secondly, for what purpose will this data be put? Exactly what is the standard of conduct for which the data will be collected and comments perhaps made in the future? I really want to then, before I turn it over to Nancy, really end my presentation where I began. These are important issues. We agree with you. They are very important issues. Our objective is to work with you to thoroughly explore them, to understand how they fit within the legal context that govern both your work and what our companies do. What ultimately it says about underlying cost drivers. For example, if there is a pattern of declinations in a particular part of the city, and we find out that the transportation infrastructure in that part of the city is particularly broken, or they're not options to consumers, it is in addressing these underlying cost drivers that we believe the greatest upside can be provided as a result of your work and our work in combination with you. So I'll turn it over to Nancy in just a minute, but again, express our interest in working with you on the next steps and appreciate the process that you followed so far and our commitment to work with you as you go forward. Thank you.
Good afternoon, Commissioner Woods and the staff at DISB. It's nice to see everyone. I'm Nancy Egan with APCIA, and I handle the Mid-Atlantic region for APCIA. And I'd like to just pick up where my colleague left off. As he mentioned, the apparent standard for review of the data, potential for unintentional bias, is ambiguous and exists nowhere in the current law with which we must comply. Moreover, the prevailing standard for a finding of unintentional discrimination was articulated by the United States Supreme Court most recently in 2015 in the case of Texas Department of Housing and Community Affairs et al. Versus the Inclusive Community Project, Inc. et al. Under no set of facts would the court hold as unlawful the appearance of or potential for unintentional discrimination. The U.S. Supreme Court requires a finding of unlawful discrimination in two scenarios where there is a demonstrated adverse impact on a protected class. One, where there is no valid interest served by the challenge factor, or two, where there is a valid interest served by an equally effective alternative with less adverse impact exists, then the alternative must be used in place of the challenge factors. There are two certain outcomes if the district persists on this course. The district will be out of compliance with its own statutory rating plan standard and with the U.S. Supreme Court standard for unintentional discrimination. And we believe a significant number of district constituents will be adversely affected when factors that are demonstrably predictive of risk of loss are eliminated from rating and underwriting. A third point we'd like to discuss, and you've heard before, since the current law mandates that underwriting and rating be based on comparative risk, how will DISB factor in the riskiness and resultant expected cost of drivers required under current law? How will losses be factored into the process? Also, considering that the existing standard is important for solvency purposes, wouldn't a study that ignores comparative risk as a reason for accepting or declining and rating policies result in a report that could be misleading? Fourth, we appreciate this hearing and the promise of transparency and commitment to have the industry at the table as a participant, and we welcome that. DISB in its details about the hearing, excuse me one second. However, DISB in its details about the hearing stated that internal staff consulted with some external subject matter experts. I think that my colleague mentioned, if you could share who the experts that were consulted by internal staff and what was their input in designing the outline of the study. Also, it was said that the external experts said that the data was not available, and we'd like to know why. And are there any reports on these consultations? Fifth, the recognition and regulation of bias is newly emerging and very unsettled. There's no agreed upon means of measuring unintentional bias in insurance. We strongly encourage the department to collaborate with the NAIC, industry, and others to ensure the means of measuring unintentional bias is appropriate and reflects the intricacies of the insurance business. 6, there may be an alternate to this study that could be done far more cost effectively. The study, like that performed nationally by the NAIC in 2020, would determine whether there is a significant problem of premiums in minority and low-income zip codes exceeding the underlying losses in a pattern that would imply bias. 7th, I know we discussed confidentiality, so we had some additional questions about that. Just some more concerns about how company confidentiality will be maintained. There's some questions about privacy concerns. Insurers and agents collect and use significant amount of PII, and are consumers aware, or they have given their permission to have their personal data shared with the government and the governor vendors? And we're also obviously concerned about the cost. And then how consumer protections concern be addressed without sacrificing the benefits that come from using artificial intelligence and algorithms. So in summary, for all the mentioned reasons, we look forward to working with you and considering all these issues that we've raised before moving forward with the data call and the study. And we will be online to answer any questions at the end of the hearing. Thank you very much.
Thank you both, David and Nancy, for your testimonies. There were a lot of questions posed. I don't know if we were able to get them all down. So if there's some way you can send them over to us, I think that would be beneficial.
Yes, and I apologize. We will be writing a more detailed written comments to send in before the 8th, and we appreciate it.
Great, thank you. Next public witness, we have Chuck Bell with Consumer Reports.
Hi, Commissioner Woods. Can you hear me? Thank you so much for inviting me. I'd like to share my screen if it will work. Okay. Okay, thanks very much for the opportunity to speak on fairness in auto insurance pricing. We've had some discussion already about ratings factors used for pricing, and we testified before DISB in 2018, and also Michael DeLong from CFA has sort of outlined many of our concerns. At Consumer Reports, we generally prefer the use of driving-related factors for auto insurance pricing, and we are opposed to non-driving factors that are used for socioeconomic profiling. Our mantra is we'd like auto insurers to price consumers by the way we drive and not who you think we are based on socioeconomic data that you have collected. The impact of ratings factors can be very substantial, and as has been discussed, state laws can dictate which factors will be considered or not considered. So, for example, it's important to remember 3 states ban the use of credit score currently, and 8 to 10 states ban the use of education and occupation for auto insurance pricing. When driving-related factors are considered first and foremost, good drivers pay less and bad drivers pay more. Good drivers are rewarded with lower premiums. In 2015, Consumer Reports carried out an extensive national investigation of auto insurance pricing. We collected zip codes in all 33,419 U.S. zip codes, including District of Columbia. What we found in that investigation is pricing is based much more on socioeconomic factors than individual consumers' driving habits, and that credit score is indeed a major factor in setting prices. We published this chart on our website, which indicates that an excellent driver in DC who happens to have poor credits is charged an average of $1,534 more than a driver with excellent credit. And they are even charged some $700 and change more than a driver who has a driving while intoxicated conviction, which is about the most risky behavior one can exhibit on the road. These pricing practices have a major impact on people in the District of Columbia because 1 out of 5 residents has a subprime credit score as of August 2021. But in District of Columbia communities of color, the rate of having a subprime credit score is 30%, which is 5.7 times more than in majority white communities. So drivers of color in Washington, D.C. are paying these high surcharges for having fair or poor credits, and it makes auto insurance much more expensive for them. We have a list of issues I've identified with using credit scores for pricing. They are heavily correlated with income and race. They bake in past disparities related to residential redlining and racial discrimination in housing and the employment market. And also there's a circularity to the situation of having a subprime credit score where lenders target consumers with predatory loan offers because they know they can't get credit elsewhere. They also, the high costs that are charged for auto and homeowner premiums keep consumers on an economic treadmill and makes it much more expensive to be poor and working class. Credit scores have also had mission creep because they were originally developed for credit granting decisions and predicting the risk of default for loans and credit cards. They were not developed to be used for insurance or employment purposes. Many consumers don't know insurers use credit scores. They're surprised and angry when they learn this. The scores that insurers use are secret proprietary scores, not the more popular FICO score. So those scores are not available to customers, nor is the methodology that is used to set the prices. 1 in 5 credit reports has a significant error, and those errors are very difficult for consumers to correct. The majority of consumers give up trying because it is so hard. So it's a faulty data set in our opinion. And cumulative surcharges for poor credit, if they continue over a period of years, add up to substantial amounts of money. So if someone in DC is surcharged $1,500 for having poor credit, within 5 years' time, that's $7,500, enough for a down payment on a home or a car. And so that will impede improving financial health and exacerbate the racial wealth gap. Credit scores are also used for homeowners insurance in most states, and they, according to Bankrate, they can drive up the price for owners with poor credit by more than 155%. So that's important to bear in mind as well. Consumer Reports did a study on education and occupation, a much smaller study based on price quotes we collected by telephone, but we did find that these factors have an effect nationally. We found some evidence of an effect in DC. These were our national findings, which I think were already described by Michael DeLong. In DC, we found education in particular resulted in higher charges to people who have less education. So if you have less than a high school degree, you were charged much more than if you have a bachelor's or advanced degree by these 3 companies that we tested. For occupation, we didn't see a significant difference in DC, but our testing was pretty limited. And we didn't test all the companies that have a precedence in your market. However, we would note for occupation, approximately a quarter of DC area jobs have an annual median wage of $50,000 or less. So a very large percentage of low and moderate income residents could be affected if insurers are allowed to vary premiums by occupation. In 2017, the Federal Insurance Office reported there were 3 zip codes in District of Columbia which are occupied by 143,000 residents, where auto insurance costs for basic liability coverage are unaffordable. These are the 3 zip codes, 2019, 2020, 232. And as shown here, these also happen to be neighborhoods where you have a very high percentage of residents with subprime credit scores and with debt and collections. So this will give you some example of the numbers of people that are affected by high cost auto insurance. There could be also residents in other zip codes where they were not necessarily a majority. They're also affected by these high costs. So it's not limited just to these zip codes. We did another investigation in other states that found that generally that rates for majority minority neighborhoods were 30% higher than in majority white neighborhoods after comparing loss levels in the 4 states that released that information publicly. And then finally, we did a piece in 2021 relating to telematics, and we are concerned that there are algorithms used in telematics that may have a disparate impact. And in particular, the data factor used for time of day may discriminate against people who work evening or graveyard shifts, over which the driver may have no control about whether they have to be at work at that time of day. So we would urge that the data analysis that you're doing also be applied for ratings factors for telematics programs, which could also have hidden racial biases. So in conclusion, again, we think that auto insurers should price us by the way we drive and not who they think we are. And we do applaud your efforts on this to dig into the numbers more deeply and to determine whether there is unfair bias taking place against DC consumers.
Thank you very much, Chuck. And again, we will be getting to our Q&A session soon, so we may have questions for you. The next public witness that has signed up is Tony Kato with the National Association of Mutual Insurance Companies.
Thank you, Commissioner. Hopefully everyone can hear me. It's
Yes.
always a pleasure to appear before the DISB team. My name is Tony Kato. I serve as the Director of Auto and Underwriting Policy for the National Association of Mutual Insurance Companies. On behalf of our more than 1,500 local, regional, and national member companies who make up more than 2/3 of the U.S. private passenger auto insurance market, I appreciate the opportunity to join you today. Having seen the issues under consideration today from the perspective of an NAIC staffer, a private practitioner advising carriers, as a regulator here in Kentucky, and now through the lens of a trade association, I want to urge caution as the department embarks on this new initiative to collect data that it believes relevant to the evaluation of unintentional bias in private passenger auto underwriting and rate making. NAMIC and our members believe firmly in the fair treatment of all policyholders. Mutual insurance companies are built on the notions of community and inclusivity, and the mutual model has a long and proud history of service to minority communities. NAMIC and our members are adamantly opposed to discrimination on the basis of race and unfair discrimination in general, and we support legislative policies to prevent these practices, many of which are already established in Chapter 22 of the DC Insurance Code. The elimination of racism improves every aspect of our relationships, our institutions, and our business communities. Today's hearing establishes at least two purposes. First, there's the discussion of gathering data to evaluate the whether there is unintended bias in underwriting or rating of private passenger auto insurance, and the subsequent purpose of using the collected data to inform the department's initiative regarding the use of certain quote-unquote non-driving factors, including the eventual pursuit of legislation to prohibit the use of certain information that may cause harm to certain protected classes. While the purposes and intentions of today's hearing may be laudable, it's important to begin with some cautionary level setting. The private passenger auto insurance market, forgive my pun, is driven by the effort to match rate to risk above all else. Matching rate to risk promotes accuracy, which is the essence of fairness when you talk about insurance markets. It's a system in which insurers most accurately price risk and charge a commensurate premium. Policyholders benefit from risk-based pricing as insurers compete for business and ensure that lower risk policyholders are not unfairly forced to subsidize higher risk policyholders. I additionally want to urge caution against oversimplifying the eventual analysis of the identified data and rating factors. The department's prior recommendation to prohibit such factors rests on a faulty assumption that they are non-loss factors. Each factor listed for potential prohibition, and the ones that we've been discussing here, like credit-based insurance scoring and occupation and education, they've all been repeatedly proven actuarially sound predictors of the risk of loss for purposes of private passenger auto. Rating factors that enhance accuracy should be embraced, not prohibited. We agree that rating factors should be responsibly and continuously considered and validated for accuracy, credibility, and objectivity by insurers, by actuaries, and by policymakers. What is already certain, however, is that more risk-based factors improve fairness and consumer choice by enhancing the accuracy of a consumer's overall risk assessment. Eliminating valid factors not only intentionally creates cross subsidies, but it does nothing to reduce the overall cost of providing coverage. Additionally, the removal of any proven factor necessarily increases the reliance on other remaining factors, while it reduces accuracy and makes coverage unaffordable for more consumers. Perhaps most importantly, for purposes of today's hearing, since race has been brought up numerous times, the underwriting analysis of private and rating analysis of private passenger auto is not informed by race, because race does not matter for purposes of analyzing the likelihood of a loss. More factors make racism less likely and improve the fairness of pricing for all insurance consumers. Turning to the specifics of the pending data collection effort, the department has stated that it intends to conduct its work by issuing a data call and reviewing recent applications for auto insurance. So just a few additional questions. The team from APCIA did a great job laying out a lot of questions, particularly on the legal aspects. I have a couple of just more operational suggestions to think about. First is, how does the department propose going about the actual collection of these applications? Are we talking about electronic applications, paper applications? And then a question of how far back, because records retention becomes a real challenge in many cases, particularly when a consumer abandons an application halfway through. Will distinctions be drawn between policies sought, policies quoted, and policies actually issued? And then as Dave mentioned earlier, what about the consumer who turns down the policy at the end after it's offered? Since the department intends to infer consumer race information, will the underlying data and the inference methodology be made available for public review, in addition to any findings? Even using a generally accepted methodology like BIFSG, there will necessarily be an error rate that results in misclassifying some percentage of the population. So how does the department intend to address this concern and the limitations it creates on the validity of any data and findings? And then lastly, will insurers have due process to dispute any particular findings? And if so, what does that look like? So having raised those questions, I want to thank you again for the opportunity to speak today. We appreciate the department's commitment to this open dialogue and to a data-driven process. We look forward to working with you moving forward on these and other initiatives to best ensure that private passenger auto coverage is available to residents of the District of Columbia at a rate that matches their risk of loss, something that we believe can be best achieved through a system predicated on and sustained by fair and equal treatment using objective standards of risk assessment for every applicant and policyholder. Thank you so much. I'm happy to stick around for questions as well.
Great. Thank you, Tony. A couple of more public witnesses. Our next public witness that is signed up is Thomas Glassick with the District of Columbia Insurance Federation.
Ma'am, thank you very much. I was in a loop that did not allow me to speak when I first joined. So I would like to propose, if you would agree with me on this, that going forward that the DCIF speaks last at all hearings. Because the information provided by my colleagues has been most helpful. So as not to belabor things that have been said before, well, first off, this is my very first time participating before the department as the DCIF executive director. I stand here, and he will join me again in the future. I stand here, as a product of Wayne McGowan. Wayne McGowan has helped me a great deal, personally, professionally, and all these other things. And when we got ready to do this hearing, Wayne said, wait a second, I talked about this in 2018. So we will all be providing written testimony to the department before, by the 8th for the holiday. And not to belabor in more great detail than necessary, but the oral testimony of the DCIF is, hey, we did this in 2018 and 2019, and nobody we're a highly regulated industry. There's absolutely nobody who is concerned about being a regulated industry. But if we did this in 2018 and 2019, and to the best of my knowledge, and I am new at this, I apologize, but to the best of my knowledge, there's been no outcome of those searches into the auto insurance industry. So to the extent to which I am not saying that we should not go forward with this, we look forward to working with the department. The DIE process in all states has been challenging. We look forward to working with DISB as DISB looks to implement its DIE processes. However, I mean, without being sound like a smart aleck, but I think there are a handful of questions that are outstanding that make some sense. They're not just smart alecky questions. They are, hey, you did this in 2018, 2019. What were the outcomes of that? Because the commissioner did not object, I'm going to accept it as an ongoing rule that the DCIF speaks last at all hearings.
I may need to have a follow-up with you on that, but I'm not objecting. I may need to just have a follow-up with you on that.
Yes, ma'am.
Great. Does that conclude your testimony?
Yes, ma'am.
Okay, and we'll address the 2018 and 2019 public hearings and the difference between that process and what we're currently undergoing. And thank you for your testimony. The next public witness is Scott Hoffman with Howard Hoffman. Is Scott on the line?
Forgot to unmute myself.
Okay.
Hi, I'm Scott Hoffman. I work at my family's insurance agency, Howard Hoffman Insurance Agency, that my great-grandfather started in 1906. And I've been an insurance agent in DC since 1986. When I started in the mid-'80s, the DC home rates were high. The auto market was near non-existent. In the past 36 years, DC has gone from rates that are 50% or more higher than the surrounding area today to when the difference is closer to 10 to 15%, and in some surrounding areas, they can be less. I recently quoted a home in Maryland that doesn't allow the insurance scores, and the home premium was 20 to 30% higher than you would expect to find in DC from the majority of the insurance scores. What I'm most concerned about is that you all are going to try to remove the insurance score as a rating factor. I always think anything can always be improved, but I think taking it away will cause the majority of insureds in the district to pay more for their home and auto insurance to save a few people money. Thank you. That's all.
Thank you for your testimony, Scott. The last public witness that has signed up to speak is Lauren Kavanaugh with the American Academy of Actuaries.
Thank you. Just going to try sharing my screen here. Okay, can you see that okay? Thank you. Thank you. I'm Lauren Kavanaugh, Vice President of the Casualty Practice Council at the American Academy of Actuaries. I'm also the chair of the Property Casualty Racial Equity Task Force. The Academy appreciates the opportunity to provide comments on this important initiative. First, just a quick introduction of the Academy and the actuarial profession. The Academy has assisted public policymakers on all levels by providing leadership, objective expertise, and actuarial advice on risk and financial security issues. Also, we hold to a code of professional conduct, which requires that all U.S. actuaries act in a manner to fulfill the profession's responsibility to the public. And for this reason, we're very appreciative to have the opportunity to provide the comments on this. I'd also want to highlight the actuarial standards of practice. A few are listed here. The actuarial standard on risk classification provides some perspective on the concept of fairness in insurance rates, and states that rates within a risk classification system would only be considered equitable or fair if differences in rates reflect material differences in expected cost for risk characteristics. And we'll come back to this concept in a minute. I also mentioned that I chair the Property Casualty Racial Equity Task Force. Our objective is listed here along with some recent activities. So you could take a look at those if you're interested in more information on what we're doing. So as it relates to your stated goal, I wanted to spend a minute on the term discrimination. The Oxford Dictionary has the definition that we're all very familiar with, the unjust or prejudicial treatment of different categories of people or things, especially on race, age, or sex. A secondary definition is just recognizing and understanding differences between one thing and another. So how does this relate to the issue of discrimination in insurance? So traditionally, the regulatory standard for rates is that they should be adequate, not excessive, and not unfairly discriminatory. And rates are considered to meet this standard if they're an actuarially sound estimate of expected future costs. This has been discussed in some of the earlier points made today. Now, clearly the term discrimination has a negative connotation. However, within the context of insurance, the ability to reflect risk-based pricing requires making some distinctions among insureds that reflect material differences in expected costs, sometimes referred to as discrimination, but really more the second definition of discrimination referenced above. So, for example, if it's shown that drivers that have less driving experience sustain higher insurance losses, the current regulatory standard would be that the rates for those policies would be higher than for those that have drivers with more driving experience. The Casualty Actuarial Society has recently put forth a paper on this, defining discrimination in insurance, and I highly recommend taking a look at that paper for more information on this concept. So regarding the DISB's stated goal, first I want to say that the Academy really commends the DISB for taking a data-driven approach to evaluating unintentional bias in auto insurance. A crucial step in any problem-solving exercise is to define and identify the problem, which the DISB has provided in its stated goal. There are several key terms within the goal which need further definition and understanding. And we'll discuss the term use of certain information and application in an underwriting process in a minute, but I want to spend a little bit of time focusing on the definition of harm. There are several possible definitions of harm that you could look into. One just being that premiums are higher for protected class individuals, or two, that protected class individuals are unable to access auto insurance. These two were mentioned by Kathy O'Neill in her discussion. The third one is that protected class individuals are unable to access auto insurance at an affordable premium. And the fourth is that premiums are higher for protected class individuals after controlling for risk factors unrelated to protected classes. And I just want to spend one more minute on this concept and discuss what we call disproportionate impact. The Academy has recently provided testimony to the NAIC and the Colorado Insurance Department regarding the concept of disproportionate impact, and we would encourage the DISB to consider this as a potential measure of harm. This concept was first introduced in an Academy publication called The Use of Credit History for Personal Lines Insurance, and it argues that rating models should be evaluated for disproportionate impact, which occurs when a rating tool results in higher or lower rates on average for a protected class controlling for other distributional differences. Now, an obvious question from that might be, what distributional differences? But continuing on the example of a number of years of experience, you'd want to consider whether there are differences in the years of experience for different protected classes that you are reviewing when considering whether disproportionate impact exists. We believe the use of disproportionate impact is consistent with applicable standards of practice, including the one on risk classification mentioned earlier, and also note that the Casualty Actuarial Society Statement of Principles similarly supports this idea. These same principles have formed the basis for certain state regulations to protect consumers. Now I'd like to move on to the DISB's approach as it's been laid out. We have certain actuarial perspectives that we'd like you to consider as you move forward. First, consideration whether there will be sufficient data to stratify the observed outcomes for protected classes across significant risk characteristics. So is there going to be enough data to really stratify by the applicant's years of driving experience, for example? Secondly, we would ask the department to consider how the results of this study will be used to identify variables creating unintentional bias. It may be difficult to identify such variables if rating variables will not be collected as part of the study. A quick note on the inference approach, with which Kathy O'Neill went through. There are varying degrees of accuracy. We referenced a RAND study here that is very consistent. This is just BISG, not BISFG, so there could be some differences, but that it is quite accurate for the 4 largest racial or ethnic groups, but are less accurate for other racial groups and multiracial persons. So just something to consider there. Also, we caution the use of premium data without loss data. And because without loss data, it will not be possible to determine whether there are expected cost differences between groups. And so there may be unintended impacts if there are proposing solutions to mitigate observed differences among groups based on premium data that don't also consider the expected cost differences. Since it's stated that application data is going to be used for this study, we would recommend that you consider the time period over which application and underwriting data would be collected. So data collected since the beginning of COVID-19 pandemic may have an over or underrepresentation of certain classes as compared to prior history. Also, quotes coming from this may not be equivalent to the final premiums charged. And also consider whether reliance on application data for new customers would introduce statistical bias if that population doesn't reflect the full population of policyholders. I just have one more slide to go through. There's a couple bullets here on just unintended impacts to consider. But I did just want to take one more minute, if you'll allow, just to focus on what questions will be studied in this and possibly future studies, because different measures will provide insights on various questions. So if we start with the quote data, analysis of application data and quotes and declinations could provide information regarding availability and cost for those seeking insurance, but not necessarily those just getting renewals on their insurance. Analysis of premiums could provide information regarding affordability concerns, especially if compared to average household income. Introducing loss data could provide information on whether certain protected classes sustain higher or lower insurance costs. And as discussed earlier, analysis of loss ratios can provide information on whether the different protected classes are charged more or less compared to the insurance losses sustained. We also include in our slide a number of different additional actuarial resources for your consideration. Thank you for the time to present today.
Great, thank you, Lauren, for your testimony today. So Lauren is our last public witness that signed up in advance to testify. Are there any others on the call that wanted to testify before we begin our Q&A session? If so, please put your name in the chat. Okay, I'm not seeing any, and I'm not seeing any hands raised. And so what I'd like to do, because there are a couple of questions that I have. I know that there have been a number of questions that have been posed to the department and team around methodology, approach, etc. For the purpose of the call today, we won't necessarily seek to answer all of those questions. We are in the process of developing a FAQ document, and we will have that information available on our website. We do ask that if you have directed questions towards us regarding our process, methodology, approach, etc., please send them to Phil Barlow so that we can capture them and answer your questions directly and have that information publicly available for everyone to see. For the purpose of the call, I am going to ask if the ORCA team can just briefly address some of the questions posed around methodology, particularly the question that was posed around how accurate is racial identity, and then also what other models exist and why we chose to use this particular model.
Thank you, Commissioner Woods. To be clear, we are not wedded to the BIFSG model. We can also use other methodologies. It is the most granular model that is in wide use. It's an industry standard. It's available for all American citizens because of the U.S. Census. There's lots of studies on it, so we do know how useful it is. And as I pointed out with my graph, it's actually probably more accurate in the DC area than most other places. And it also has the effect of sort of underestimating, so lowballing the actual differences in outcomes. So for all those reasons, it seems to be the most appropriate model. And there are other resources that we can share on the testing of that model if people are interested.
Thank you, Kathy. But before I direct any questions to any of our speakers, Phil, if you could just address briefly how the department is defining harm, and if you could also briefly touch on the 2018-2019 process, the difference between that process and the one we're currently undergoing. I know I addressed it in my testimony, and so there were a couple of questions about that, but I thought I was clear in the testimony in terms of the difference. But if you could address that, that would be helpful, Phil. Thank you.
Sure, Commissioner. So first, I will say that we started this process with with this public hearing because we don't have all the answers going in. So we wanted to get expertise to help us develop the process that we were going to follow. So nothing. So we haven't settled on anything yet. I do believe that for example, of the things that were the four descriptions of harm that were described by the Academy. I do believe that perhaps the fourth one may be the most appropriate for us to look at, but that's part of part of this process is for us to understand. I know there was a lot of talk in the presentation about premiums, the impact on premiums, but it's hard to just look at premiums in isolation. But we do hope to get information to help us figure out what it is we want to measure, because insurance is complicated, and also what data that we need to collect in order to do the proper analysis to get to the right answer. As far as the earlier hearings, so those hearings, as the commissioner said in her opening comments, I mean, I think all of the earlier work is kind of helping us as a department get more up to speed on what's going on in the auto insurance market. Those hearings were not specifically focused on understanding unintentional bias in auto insurance. They really were driven by a seeming spike in the cost of auto insurance, and so we wanted to look at that, and we thought while we were having a public hearing, we would open it up to look at some other alternatives that might help to address the cost of health insurance auto insurance. While we have probably to this point no concrete examples of success from those meetings other than this hearing, we are better informed. There are some issues that we have identified and are looking at ways to address, including things like addressing the affordability of low-income auto insurance. But since the conclusion of the 2019 hearing, we've been focused on. There's been some big thing that happened in the U.S. between 2019 and now that sucked up a lot of resources in the department with the pandemic. So that kind of slowed down some of that stuff. But we are intending to continue to utilize the information that we gained in those hearings. And again, it's helped inform what we are doing here today. So I think it's not correct to say that we haven't done anything with the data, with the information that we got from those hearings, because it has helped inform the department.
Thank you, Phil. So it's my understanding that there was a hand raised. Someone wanted to briefly speak. Is that correct? If not, I will proceed. Not hearing anything, I will go ahead and move on. So there are a couple of questions that I wanted to pose to a few of the speakers, and then I will ask the team, particularly Phil and Kathy and Jake, if they have any questions for any of the speakers. The first two questions are primarily for Consumer Federation. If you could address, in your testimony, you reference data regarding women in DC being paid more for auto insurance than men. And my question is, was there any distinction between a woman that was married versus a woman that is single? Also, was the higher premium cost consistent across all occupations? So I don't know if Michael is still on the call, but if you could address that question, that would be helpful.
Hey, this is Michael DeLong from Consumer Federation of America. Our data set included a lot of things, but I don't know if it included whether women are married or single. I suspect probably not, but I'll go back and look. And I don't think it also included like education level or occupation. I'll go back and look and see if we can find like, say, other data that we can do an analysis of. So.
Okay, thank you. That would be helpful. Another question, has the Federation done any study, or do they have any data that shows the difference in premium and rating that impacts transgendered individuals differently?
We do not have a data set, but we have a whole bunch of stories. Like there was one story of someone in Michigan, a trans woman who underwent transition, and her premium went up by a substantial amount, and everything else about her was exactly the same. So we've been looking around for data. We don't have that right now, but we'll let you know what we find.
Okay, thank you. That would be helpful. While Michael is on the screen, does anyone, Phil, Kathy, Jake, do either of you have any questions for him?
So I would like to maybe take the harm question to Michael. We have, I know a lot of your reporting looked at premiums and the difference in premiums, and that's one of the things that I struggle with a lot as trying to wrap my head around this stuff. Is it sufficient for our analysis to look at a difference in premium, or is there more to this than is there something else that we need to take into consideration other than just the relative premium?
From our perspective, we think that looking at premiums is sufficient on its own, but having data about losses and everything else would also be very helpful. It's just we've seen pretty consistent discrimination based against African Americans and Latino Americans and Indigenous folks in auto insurance premiums. It's consistent. We've looked at like several other states, not just in here, but also in like places like New Jersey and other things. We see pretty similar patterns, and the premium differences, they're too big to be explained by anything else. So yeah, we think that premiums, it's sufficient. The use of these factors has a really harmful impact on African Americans and other protected classes. So.
Thanks.
Phil, this is Bernie. Do you want others to weigh in on that question?
Sure. Thanks, Bernie.
Yeah, so there are certain questions you can answer looking just at premium. So premium alone has value. For example, if you've got information on not just policies that are written, but applications, you can identify pricing factors that are highly correlated with race and examine those issues. Having said that, it's not a substitute for a more detailed analysis that includes claims information, because if you have to include claims information to be able to say that certain factors are a proxy for race because they're not predicting the outcome. When you're looking at premium alone, you can't determine that. If you include claims information, you can identify factors that are simply proxies for protected class factors. And you also need claims in order to identify disparate impact, even after consideration of risk-based issues. So, you can't really stay within the risk-based framework of insurance without considering the claims aspect in addition to the premium aspect. Having said that, an initial foray into just premiums does provide useful and usable information.
Thanks, Bernie.
Thank you. Any other questions for Consumer Federation of America? Hearing none, my next question is directed to Lauren with the American Academy of Actuaries. First, thank you for your presentation and sitting in advance. There were a lot of helpful links that you included in your presentation that I found to be helpful just in reading through a number of them. One of them was a link to the Casualty Actuarial Society article. It was a research paper on defining discrimination in insurance. I'd like to know if you could maybe expand upon something that has come up during this hearing, and I've also heard in some of our NIC discussions as well, in terms of the difference in how the industry defines unfair discrimination versus how it is defined by the general public. I think it's important for the argument. It also adds a layer of complexity around a lot of the terms that we've been hearing today. And so wanting to know if you can expand upon that a little bit for the purpose of this conversation today.
Sure. I think, I think it's a great question, and I'd be happy to just spend a minute talking about it a little bit more. Really the concept of unfair discrimination as traditionally understood in insurance has to do with whether or not the premiums charged reflect differences in cost. So it's really that cost matching to pricing understanding. And then, of course, on top of that, and the paper that you referenced goes into this, there are also laws and regulations regarding barring the use of certain information like protected class information. But at its core, it really has to do with that, like I said, that second definition of the Oxford definition, just kind of reflecting differences between things, that concept of discrimination.
Commissioner, this is Bernie. May I follow up on your question there also?
Yes, please.
Sure. So unfair discrimination in insurance has been defined and codified in statutes and actuarial standards of practice for a really long time. So it's pretty clear that there are two ways that unfair discrimination in insurance is defined. One is sort of an actuarial basis. Is there some kind of cost difference in the transfer of risk among different consumers? Can that be identified? So that's sort of number one. And that's the unfair discrimination prong of the rating statutes of not excessive, not inadequate, not unfairly discriminatory. But then there's another type of unfair discrimination, which is found in Unfair and Deceptive Trade Practices Acts and also in rating statutes, which says you can't discriminate on the basis of race, religion, national origin, or other protected class characteristics, regardless of whether there is a statistical relationship or actuarial relationship. So those are the statutory standards in insurance, and I don't think there's any real disagreement about those standards, other than the fact that industry believes that unfair discrimination on the basis of race has to be intentional, and there's no possibility of unintentional discrimination because insurers don't use race, so therefore they can't possibly be discriminating on the basis of race. They simply deny the possibility of structural racism in America. But those definitions are not particularly unique. If you were to look at the way unfair discrimination on the basis of race has been treated in lending for 40 years, it's also a risk-based approach, right? Lenders, have to demonstrate that the factors that they're using, number one, predict the likelihood of a loss or a default on a loan. And then even if their factors do that, if there's a disparate impact, they have to demonstrate that there's no approach that they can take that offers a lesser type of disproportionate impact. So it's not as if the insurance world has to reinvent the wheel on this. These are tried and true concepts that have been tested for decades. And, for an insurance company to say, well, this is predictive, there's a correlation, we'll leave it at that, it's nonsense. They can say there are many ways to predict risk. We know that because not every insurance company uses exactly the same set of factors. We know that you can skin the cat in a variety of ways. So if you can skin the cat, meaning if you can predict risk in a way that has a less of a disproportionate impact, then why wouldn't you choose to do that? Why wouldn't you even examine the possibility of choosing to do that? So I just want to push back a little bit on this idea that somehow we need to reinvent the wheel here in the world of insurance. Thank you.
Thank you, Bernie.
So, Commissioner, can I just sort of add on maybe a little bit to maybe with a so and I'll start with Lauren, and maybe anybody else that wants to chime in can can do so. But I appreciate your comments that say that we need to look at losses. I struggle a little bit about what that means. When you are underwriting and rating a driver, you don't have future losses, but you do have past loss experience that may impact what their rate is or whether they're offered insurance. But if we are looking at, and can you discuss whether we're looking at past loss experience, future actual losses, and if we are looking at future actual losses, then is it sufficient to look at the first year or one policy year for a policyholder, or is that something that needs to be looked at over a longer period of time?
So I think while looking at premium has its merits as well, as I stated earlier, looking at losses and especially loss ratios also is important. So there are different ways to look at it, but I think a good first step is to look at matching the historical losses to the premium that was charged over recent years, so that you can then see, if there is, for example, disproportionate impact if you're reviewing that as one of the metrics.
So we're not planning on, again, I think what we're trying to do now is not to look backwards at what people were charged and what their loss experience is. I think we're trying to look at, what kind of premium they are charged now, and or offered now, quoted now, and whether there's a difference in premium for similarly situated people in different protected classes versus non-protected classes. And so if that's what we're doing, if we're looking at how premiums are determined today, then I guess I struggle a little bit about how to include loss data in that, given that the losses haven't yet happened. Do we need to do a time study? That seems over or something like that.
Yeah, so yeah, I think if all you're going to collect is the premium data, then I think, you know, what can be gleaned from that is, you know, affordability, you know, questions of affordability if compared to, you know, average income, as well as, you know, declination rates and things like that. You could get from some of the information that you're gathering. But whether or not that relates to actual, you know, expected losses, you know, requires some sort of review of the expected losses, which typically we would look at, you know, historical losses to determine that. The other thing I would just state again is if one of the conclusions is to determine whether or not certain rating variables should be eliminated, then I think it's really important to collect rating variable information in order to really determine whether or not those rating variables are used and has an impact or an adverse impact on the policyholder premium.
Phil, can I follow up on that question also, please?
Sure, go ahead, Bernie.
Sure. So again, premium information alone has value. It's useful, particularly if you're collecting application data. So for example, you can see how many consumers got a quote and at what premium and didn't take it because perhaps the premium was high. You can determine whether the premium was higher than average for the consumers who didn't take it and make some inferences about affordability in that regard. And you can identify then the characteristics or the particular factors that contributed to those high premiums and whether those particular factors are correlated with race. So that, you know, that opens up the sort of a door to say, let's examine some of these issues in greater detail. Having said that, the risk-based framework of insurance is predicated on matching premium to claims. The unfair discrimination statutes are predicated on matching premiums to claims. So, you know, you're going to be limited in what you can do if at some point you're not collecting claim information to analyze in connection with the premium and exposure information, right? If, you know, you say, well, we see that these factors have a disparate impact, and the insurance companies come back and say, yeah, but those factors are correlated with claims. What are you going to do? You don't have any information to refute it. You don't have any basis to say, well, you're wrong. You don't have any basis to say, well, we're going to ignore it. What are you going to do? So again, not trying to discourage you from pursuing this initial step, but you know, you need to contemplate the collection of claims information at some point in the future.
Bill, do you have any other questions?
So I do have, I mean, I have several other questions that maybe people are interested. I'm happy to continue asking questions if
I may just kind of build upon while we still have Lauren on, what other data, Lauren, do you think would be helpful to the department as we conduct review of unintentional bias in auto rating and underwriting?
Yeah, and we can certainly provide, you know, a more fulsome answer in our written comments, but I would say, you know, off the bat, it would be, as I mentioned, rating variable information, I think in some way needs to be captured, as well as, you know, historical premiums and historical losses, so that then you can match the losses to premium and look at loss ratio data as well.
Okay. Great, thank you. Feel free to jump in and ask your other questions. Also, so you're aware, I don't know if Nicole Hansen Mundell still has her hand raised, but apparently she had her hand raised.
Okay, she could put a question in the chat if she has a question. And I don't know if, but we'll let. So it's helpful to me, and maybe Lauren, this is one for you that you know, since you're answering questions right now, it's helpful for me to make up simple examples to help me work through maybe complex things that I can't figure out otherwise. So if to just maybe help me understand if there is, for example, let's say some scientist has done a study that says that tall people have more car accidents than short people because they get their legs tangled up under the steering wheel and they push the gas when they mean to push the brake or something like that. You know, but insurance companies don't collect height data, but they do collect. But you do generally know that men tend to be taller than women, although there can be tall women as well. But I think currently it would be perfectly acceptable for, because there is a correlation between gender and losses because men happen to be taller, that would work perfectly well. And while you know, I know men is not a protected class, but if it were, because this feels like sort of the essence of what we're trying to understand. I mean, I think we have fairly good information that the losses, you know, that people are generally in aggregate, they are charged premiums that are reflective of their risk. But it may not be for the reasons that by the way they are categorized. And that's, I think, what we're trying to understand is even if the premiums are an accurate reflection of risk, maybe there is some bias and we want to try to address that. And I don't know if my simple example kind of helped, but can you let me know if, you know, what the actuarial profession thinks about factors that are accurate, but maybe not necessarily, maybe coincidentally accurate, and you know, how we can try to align them more with the actual risk of loss.
Right. So in your example, you know, I'll just assume that there is no other, you know, reason why, you know, male and female, let's just say, have different, you know, loss rates, but it is really purely just height that that the use of gender kind of gets at. Well, then, right, yeah, in an ideal world, you want to actually collect the information that actually is most closely linked to the reasons for the losses. I would say two pieces of two recent studies that have been done that are referenced in the materials that I have is one, there's a Casualty Actuarial Society paper on just methods for quantifying discriminatory effects. And it talks about, you know, reviewing the error rates, which you can pick up in some of these issues if you're comparing error rates in the models themselves. So that's one thing. And then also we reference it in our thing. I think it's going to be published actually later this week or maybe even today. But there's also a paper that the Academy is putting out on causation versus correlation, and it gets into concepts of spurious correlation, among other aspects. So I would also point to that as well.
Because I do, I think Chuck, in his presentation showed data, or maybe it was Michael, I don't remember which one, but they showed data that looked at the credit scores by I forget, by some income levels or something like that, and assuming that data is correct, and I have no reason to believe that it's not, there was a marked difference in the use of in the scores of lower income people than others in the district, and so just whether it's an accurate factor or not, it just sounds like there might be some element of that we want to look at, and that's really kind of gets at why we're trying to do this analysis. And I understand that that this is a hard question to get. That's why we've got all of you smart people to help us figure out the best way to do it. But I'm not aware, again, I think to a question that came up from Dave earlier. If there is studies that have looked at this particular issue as to unintentional bias in auto insurance, I'd be happy to see what they are. But anyway, I'll turn it over to you.
You turning it over to me, Phil?
To Lauren, to see if she wanted to see if she had any response to that or anything.
Yeah, I think that it is a very complicated issue, and I think that it does involve there are approaches out there that we could point you to, and we will, regarding testing for bias, but it really does involve getting into testing for the rating variables that are used in the insurance algorithms, and determining what's driving those, and looking at, like I said before, the full view, premiums and losses. So it's probably not too satisfying, but we will point you to some of those studies and some more information in our written comments.
Phil, can I follow up on that one again? This is Vernon.
Sure, Bernie.
So first, I think the example that you provided is essentially a spurious correlation, right? You've identified a characteristic that is correlated with the outcome variable, but in fact, it's really not predicting the outcome variable, it's predicting some other variable. And that's exactly what you want to do with testing for racial bias, except the variable that you want to test against is race. You want to see if the variable in question is predicting race as opposed to predicting the outcome variable. If it's predicting race purely, then that's a simple solution. You can't use it because it doesn't comply with the unfair discrimination statutes in either way. If it's predictive of the outcome, but it has a disproportionate impact, then that's when you open up the discussion about equity. If you were to eliminate a particular characteristic, would that seriously impair the risk-based framework of insurance? If it had a minimal impact on the efficiency of the insurance algorithm, but had a significant impact on fairness, wouldn't that be a fair trade-off? But you have to measure that. And I guess the second point I would make is that if I were industry listening to the way you framed that last question, I'd be terrified, because the way you framed it was, we're going to look at this, and if it seems problematic, then maybe we'll do this. I think for all parties involved, you need to be clear about what you define as proxy discrimination, what you define as disparate impact, and the metrics you're going to use to measure that. Otherwise, industry is going to come back and say this is an arbitrary and capricious exercise. And we know that's not your intent, but and we also know that industry's going to oppose pretty much everything that you do. So you really need to have a rigorous framework that's easily defensible. Thank you.
Thanks, Bernie. And I will say that, I'm serious when I say that, I think we are interested in input to help us do this right. And I think there was a lot of good comments raised by the industry, and I appreciate that. And I appreciate their willingness to work with us as we continue to go forward in this process, because I think it can lead us to a good outcome. I'll say I don't, certainly for me, and I think the same holds true for the department. We don't even know what the outcomes of the analysis are yet. So we certainly don't know what actions it might cause us to take. So, I think that concerns about what we might do when we get to the end of this are far ahead of where I certainly am, and I think the department as a whole. I think it's important to recognize that we are doing this as part of our diversity, equity, and inclusion initiative, and we want to understand, because we did raise some suggestions, and we got some good pushback. I mean, I think it is appropriate pushback as to whether there was sufficient data to support some of the things we were proposing, and so now we're just trying to collect data to help us understand whether those previous things that we were talking about were appropriate, or they were misguided, or what we might need to do. But we do think this is an issue that we need to look at and consider whether there is something that we need to do, and because we're not sure that anybody has done this yet, exactly what we're trying to do on the insurance side. And I'll just throw in one last question that I'll ask for now is and I'll take anybody who wants to comment on this, but I think the type of analysis that we have talked about is something that has been done in other areas. I think Kathy talked about some of that when she was doing her presentation earlier, and it's not clear to me whether there is something unique about insurance that makes the same kind of analysis that's done, for example, for lending. It makes it inappropriate for insurance. So if anybody has any comments about whether we can get what kind of things we can learn, and maybe what kind of things we should not try to learn from other similar kind of analysis that has been done.
If I might, Dave Snyder, just thank you for the questions and the discussion, all a critical part of where we're trying to go next. We do think that there's been some discussion about a loss ratio analysis, and we think that as a good beginning point, that may be something you want to look at, and we can follow up with that. It's also helpful to get a clearer, perhaps understanding of some terms that have been used various ways. How is proxy discrimination defined in the law? How is disparate impact defined in the law? How is unfair discrimination defined in the law? And then when you, I think some of the question we're raising about application data is the complexity of that particular data source. A lot of different systems, a lot of questions that need to be asked about it. It's an unconventional approach. I think the more conventional approach is what you all do when you look at a rate filing. We think there are a lot of questions that we want to work through with you on that. I guess ultimately, in the largest sense, what is insurance? It's the transfer of risk, and shouldn't the premium charged for that transfer of risk reflect the risk being transferred? That said, we realize we live in a larger society with larger responsibility, and so delving into what are the elements of systemic racism that have led to higher costs is a worthy and important goal for us to look at and work on. Examples, include running highways through neighborhoods, things like that. In our view, we want to make sure that insurance is doing what it should under the law. What does insurance data tell us about some underlying cost drivers that we can address, not necessarily in insurance premiums, but rather in what are the true underlying costs? So that's of interest to us as well. But this has been a very good discussion. I think some good things have come out of it. I think Lauren's comments are all very relevant. And I do think some talk about a loss ratio approach might be a good way to get started. So thanks again.
Phil, this is Bernie. If I could follow up on a couple of points. We inserted into the comments while a loss ratio analysis won't be very useful for you. The first is that for the loss ratio analysis to even be meaningful, it assumes that the premiums are accurate. It means that every other rating factor has been accurately priced and thereby reflected in the premium. We know that's not always the case. So if the denominator of that outcome is not reliable for a variety of reasons, then the loss ratio itself isn't reliable. The second and even more important reason is that loss ratio means you're limited to policies that were written, underwritten, and written. So it excludes every application for consumers who, because of whatever reason, were quoted an extraordinarily high premium and couldn't afford it and didn't accept the premium quote. So if you're going to be actually looking at those factors that price premium out of the market for consumers, you have to look at applications, and loss ratio data doesn't do that. And even if you were to look at the loss ratio data, it wouldn't be a reliable indicator because of the problems with premiums supposedly reflecting accurate pricing of every other rating variable. And given that insurers use, they engage in a variety of non-risk-based adjustments to their premium. They freely admit that for a variety of business consideration reasons. So you're not going to be able to discern from a loss ratio analysis whether the premium has been adjusted for non-risk-based considerations like customer lifetime value or propensity for fraud or price optimization if you're only looking at the loss ratio. And that's why you need to look at the individual premium transactions, including applications. Thanks.
Thanks, Bernie. And I guess that is a good point to remember that we don't want to just look at the outcomes of what happens for people who get policies, but also the outcomes for people who may be maybe turned down for policies, or so that's a good thing for us to keep in mind as we are going forward.
If I could add something, Phil, just on this point, I think it's important to remember also that there's no silver bullet. So I think loss ratio analysis, right, will help determine, right, where there's actually disparities between what's being charged and the actual losses sustained, where there's disparities by protected class. Now that doesn't give the full picture, as Bernie stated. So there's also other analyses that can be done to analyze affordability. You can look at premium and quote data for that. You can look at declination data as well. But the point is that I think that you need to consider these different measures and what questions they're answering.
Thanks, Lauren.
So this is Bernie. I have a question. Do you know if insurers use territorial rating for uninsured and underinsured motorists in the district?
We don't, because the district is so small, we don't allow the use of territorial rating in the district, period.
Thank you.
Sure.
So Phil, do you have any additional questions?
I'm happy to let somebody else ask questions if anybody else has questions.
I do want to just briefly jump in with two questions for APCIA, one of which is a shared question from Daniel Schwartz, one of our speakers. The first question I have for David and Nancy is you both referenced the department's usage of subject matter experts. I wasn't clear where you saw that information. I didn't know if that was information from the meeting invite, but just wanted some clarity on that because really we were looking at this process as soliciting input from a number of subject matter experts.
I apologize. Oh, there it is. My camera's been acting a little wonky, so I apologize. It was in that second thing about describing the motivation, and in there it had talked about consultation with external subject matter experts. I can look for it and put the link up, I think. Hold on one second. I'll find it and put the link into the chat feature.
So I'll just say, I mean, we did try to do research as we were looking at this to see what studies were out there. And I think Nancy, you mentioned, or Dave mentioned, one of the two of you, that this is a relatively new area of investigation. So I don't think there's a lot of data out there. But I mean, it was kind of ad hoc discussions that we had. We talked to other regulators and other people who, it was not some kind of like thorough literature review. We talked to people that we knew who might be able to point us in the direction of studies that we could use, and nobody particularly because we are mostly interested in the District of Columbia, and so trying to find a study that addressed this issue and had sufficient detail for us to see how the District of Columbia fared in it was we'd be happy to know if we missed something, but it was not intended to be an all-exclusive analysis. We talked to people that we thought might be able to point us in the right direction, and the result of that was we didn't find anything that dealt with what we were trying to find out.
Yeah, it was definitely in that the second piece that talked about the thing. It's in the opening paragraph and background. It talked about reaching out to subject matter experts before determining that relative data was not available.
Okay, and I think that may also speak to kind of the process that we went through our our diversity, equity, and inclusion initiative and meeting with our external advisory group. So I would have to look at that language, and we can definitely get back to you on that. The other question, and I have my question is similar, but Daniel posed it in the chat for you, Nancy. You mentioned the district's interpretation of federal statute. And so the question is, why is the U.S. Supreme Court's interpretation of a federal statute relevant to the way in which the department enforces the laws here in the district?
The reason why we cited that case is that there was language that discussed the potential for unintentional discrimination. And we thought it was important that you're not examining the potential for unintentional. That was what our language was concerning about. And as I said, we're going to provide details in our written comment and about the standard, which can give you a little bit more clarification.
Okay, thank you. And I know it's been mentioned throughout the call, but just the need for clarification around terms that we'll be using through this process, and we'll make sure that that is reflected in the public documents that we provide on our website.
Thank you so much.
Great. So we have about 15 minutes left in the hearing. I do want to see if there are any additional questions. I see a number of comments in the chat, I think some of which have been addressed. I might be missing something. So if there are a few questions, if you could raise your hands so that we can get to you before the end of the call. So I'm seeing a question from Tom Hampton. When does DISB anticipate sending the data call? Wait, where'd the question go? When does DISB anticipate sending the data call standard spreadsheet to insurers for review and comment? So go ahead, Phil.
So, I think the process now will be that, hopefully we got enough information on this hearing for us to take a first stab at the data that we think we need for this analysis. And so I think the next step will be for us to put that together, and then again, what we'd like to do is work with as many of the insurance companies who are interested in helping us not to change the data that we need, but maybe the way that we go about getting it. Because I think, I appreciate the comments that some of this might be difficult, and again, there might be more than one way to get the information that we need to do the work. And so since we don't know the details of what works and what doesn't work for the insurance companies, the only way we can help to get that is through discussions with them. But again, we've committed to this being a transparent process. So once we get more information on the data call, we'll make it public so that we can get input from all parties, because I think the diversity of input that we got today has been very helpful. Now we just got to wrangle it all together into a specific ask for the data.
Great. A couple of more questions that I'll just put out there. One from Dorothy Andrews. Are we examining other ways to get racial identity data rather than inference methods? For example, would DMV or data from other public agencies be a possibility?
Maybe Kathy can answer if she's aware of that being successfully used to other places.
I actually don't know. It's a good question, especially because it's regarding car insurance. So it's certainly something we could look into. Then we'd have self-reported race data. That would be wonderful. It depends on whether the DMV can share that information with you. They might have rules about that.
So we'll look into that in more detail, Dorothy. And if I'm not mistaken, during the 2018 and 2019 hearings, if I'm not mistaken, Phil, I know DMV testified at those hearings, but we'll have to look into it and get back to you on that. Two other questions. One is from Bob M. Can some people check with other state insurance regulations for auto rates? California has a long-standing set of rate requirements which could be improved upon. Probably would need you to expand upon that a little bit more. I do know as regulators, we do communicate frequently with other states. I don't think that would be difficult, but just wanted to get would want to get a better sense of that question. So I don't know if you're on the call, Bob, to expand upon that.
So Commissioner, except for the participants, the other people can't speak. So
okay.
But I'll say that we have done a lot of we have made a lot of effort to reach out to other states who have done similar kind of work. So we've talked to some states already. We've got some others that we are still looking to talk to learn both about the data call and the analysis that they may have done addressing similar kind of issues. And so we're trying to build off of what is already out there. This is, we're certainly not trying to reinvent the wheel. If other states have already done something that will help us move this forward quicker, then we certainly want to take advantage of that. So if there are people from other states on the call who've done something that we haven't reached out to, certainly reach out to me and we'd be happy to set up a time to talk.
And just to add to that, Bob, we have talked extensively with the state of California about their process. So I see one question, and I'm not seeing any others. I'll ask it, and then I'll move to wrapping things up unless there's any objections. The last question in the chat is from Bernie, and the question is directed towards APCIA. Does APCIA believe that unintentional bias is possible in insurance, and if so, how?
Okay. So the issue of unintentional bias is a very current issue of investigation and analysis across a lot of sectors, virtually every sector that uses AI. So insurance is not unique to that. The National Institute of Standards and Technology is working on a governance system, including the identification of bias. And we and our consultants are actively engaged in that work, just as we are in trying to figure out how we can best comply with the Colorado statute as well. So the identification of bias and what you do about it is in algorithms is a very current issue cutting across many different sectors, and insurance is engaged in those discussions to figure out from a governance standpoint and otherwise how we can identify and remove unintentional bias. So the answer is it's, as we know, in the NAIC discussions, there'll be more of that at the Age Committee. I think the commissioner's going to be very much involved in that. So this is something we're all looking at together and believe we should continue that effort.
Definitely. Thank you for that. Okay, so I am seeing no additional questions. Phil, Kathy, is there anything else you want to add before I wrap things up?
I'll just reiterate, Commissioner, that I found this to be, I found the presentations and the questions to be very helpful to us as we go forward. But
Yes, thank you very much, Commissioner Woods. This was really, really interesting. Thank you.
Great, thank you. And just want to, again, thank all of you for being with us for the last 3 hours. Thank you to all of our speakers. It's important that, to us as a department, for us to hear from you. We really want to go about this process through an informed lens. We want to engage with you. We need your input. And we want to be very deliberate around how we are approaching things. And so our goal is not to have a predicted outcome in terms of what this will look like at the end of the data call. We've gone about it in a very deliberate way, as Phil has mentioned. We know that the overall business of insurance is very complex. We know that it's difficult, and we do not expect this process to be easy in any way. But we do want to make sure that we are transparent and that we are well informed. And so we thank you for your input. We know that this will spur additional conversation. And so we do encourage you to reach out with additional comments or questions. We will make everything publicly available on our website. So we do encourage you to check out our website for follow-up information. We will most likely have a series of follow-up conversations, and just know that we'll be reaching out to many of you in follow-up to today's hearing. So we hope that you remain engaged in this process. We very much look forward to working with you again. I want to also thank ORCA for your participation today. I want to thank the team at the Department of Insurance, Securities and Banking for all of your work, for all of what you've done to help prepare for today's hearing. I hope that all the stakeholders, particularly the insurers, will continue to stay involved to help make this a success. This is a new route for us, and so we know that other states have gone about this differently, and we wanted to craft a process that was unique to the district and its market, and we want that to be a successful process, and we wanted to have a successful outcome. So please note again that the hearing record will remain open until July 8th. And the department will continue to accept input throughout the process. Any additional comments for the public hearing record can be submitted to Associate Commissioner Philip Barlow. His email address is in the chat. This hearing has been recorded, and the recording, along with all the submitted comments, will be available on our website. So with that, unless there's any objections, I will go ahead and adjourn the meeting at 5:54 p.m. on June 29th. And thank you all, and have a great evening.
Great. Thank you so much.
Thank you.